Yesterday, the European currency unexpectedly edged lower in early trade following upbeat data on business activity in the euro area. The manufacturing purchasing managers index increased to 48.8, while the services PMI rose to 50.7, above market expectations and the 50 mark that separates growth from contraction. The composite output index, which encompasses manufacturing and services activity, came in at 50.2 in January. Despite positive statistics, traders opted to go short. Nevertheless, the euro managed to recover after the United States reported similar data. US business activity contracted in January, though the downturn moderated across both the manufacturing and services sectors. That is, the market reaction to macroeconomic indicators was rather strange. Notably, the French and German composite indices remained below the 50 reading, indicating contraction in activity, although the outlook for the Eurozone economy is pretty bright and the chances of a soft landing for the European economy appear to be growing. Things can change. Given that the European Central Bank intends to raise interest rates further, optimism may fizzle out soon. That is why the market is experiencing volatility spikes amid uncertainty. The British pound also slid on Tuesday amid downbeat data on business activity in the UK. The manufacturing PMI increased only to 46.7. The reading pointed to a sixth consecutive month of falling factory activity. The services PMI fell to 48 in January from 49.9 in December, missing market expectations of 49.7. Accordingly, the composite index also dropped. All these triggered a steep decline in the pound sterling. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes data on output and input producer prices in Britain. However, this report is unlikely to have a severe impact on market sentiment. Market participants should take notice of IFO Institute's business climate, current assessment, and business expectations indices for Germany. The indicators are expected to increase compared to the previous month and support the European currency. As for the news from the United States, today's calendar is bereft of any significant releases except for crude oil inventories. Therefore, I think that the euro will rise in the first half of the day. In the second half of the day, traders will probably lock in profits, thus dragging the euro down. From a technical point of view, the 1-hour euro-American dollar chart shows that the level of 1.0922 acts as the upper boundary of the sideways range, in which the euro may get stuck this week. A false breakout at this mark will create a sell signal, thus bringing the euro down to 1.0865. If the price forms a false breakout at this level, the volume of long positions will increase. In this case, the European currency will recover to 1.0922. In the event of bull subdued activity at 1.0865, I recommend going short on a rebound at 1.0806 or 1.0769. Alternatively, if the price gains strong upside momentum and consolidates above the 1-month high of 1.0922, which is unlikely, its top-down test will open the way to 1.0969 and 1.1006. At these levels, it would be a wise decision to open short positions on a rebound, counting on an intraday correction of 30-35 pips. Meanwhile, the British pound is in a downward correction. If bulls regain control of 1.2336 in the first half of the day and the price tests it from the top down, a buy signal will be generated. In this case, the pound sterling will return to 1.2409 and probably to 1.2486. At the level of 1.2486, it will be possible to go short on a rebound with a view to catching an intraday correction of 35-40 pips. Short positions at 1.2409 and 1.2336 can be considered only amid a false breakout. If bears are able to protect this area, the British pound will most likely dip down to 1.2267. A false breakout at this mark will create a buy signal, thus dragging the price below yesterday's low will be a priority of bears. In this way, the pound sterling will extend its downward correction and slide to the support levels of 1.2194 and 1.2146. At these marks, traders will have a chance of going long on a rebound, counting on an intraday correction of 40-45 pips. Best of luck!